There, Jason?
Hey, Dean Gallagher's here.
Hey, Dean, it's Chris. Can you hear me?
Yeah, Chris, hear you loud and clear. Sounds great.
Cool.
How's your day going so far?
It's going good. I'm a little bit computer challenged, but I'm getting better at it.
Nice. Very nice. Jay, are you in? Hey, Jason, I think you might be on mute.
Okay, there we go.
Yep, now we got you.
Great. Can everybody see the computer screen?
Yes.
Yes, sir.
I'm going to let you guys chat. I think we're live. Everybody should be able to hear us. We got 10 people already in the room, and give them a few more minutes. I'll be right back. Why don't you guys just start off chatting about your experience and how you got involved with us, and then I'll give a presentation once we get going here in a minute.
Okay, perfect. Thank you, Jason. Yeah, so so this is Dean Gallagher from Portfolio Builder. If you're joining us today, we would love to to learn a little bit about how you found us, what your interest is, and what questions you may have. And if you do have a question, let's go ahead and type it into the chat box. Okay, and you can go ahead and find that chat box at the very bottom center of your screen. There's a little chat icon, and underneath it says chat. You can just click on that and type in any questions you may have. But we'd love to first off and foremost learn a little bit about how you found us, and maybe a little bit about your experience in the stock market.
All right, I'm back. Let's see, we've got a chat box coming in. One guy says he really loves getting lots of text messages. Just kidding. Sorry, DJ. We can always unsubscribe if you don't want to make money and get text alerts. That's perfectly fine with us. Yesterday we had a webinar with just our paid members, and 100% of them were making money and very happy. So that's something that always goes well. Jim Hart has a question. What can I do if I have less than $15,000 to start? Okay, DJ, why don't you post your info and I'll be happy to unsubscribe you, no problem. Okay, Jim says you guys are doing a great job, thank you. Yeah, no problem. So Jim, if you do Robinhood, they will give you one-to-one leverage for 5% a year. And so what comes to mind is if you had about 10 grand, you could put it at Robinhood, use one-to-one leverage, and you'd be able to follow our Diamond program, which is currently trading Apple. So Apple shares are coming in today at 195. So if you had that kind of capital, you could be following our Diamond trade alerts on Tuesday, which is really nice because it's just one trade a week, a lot less work than our basic program. And let me take a look at who all we got in here. We've got a few familiar names, I think. BJ James, David Mugavero, Howard Davidson, Jim Hart, Lema Rosher, Pavel Faulkner, Tess Wong, Ryan, Dean, and Chris. So welcome, everybody. We had been doing regular webinars on GoToMeeting, and we switched over to Zoom. And so far, we really like the platform. I'd like to start off with just a quick intro to Chris. Did you have a chance, Chris, to introduce yourself and tell them your experience, kind of not just with our program, but trying to trade the markets in general?
Well, I haven't yet. As a matter of fact, I talked to Jim yesterday, though. And hey, by the way, Jim, wanted me to call you about that Diamond program so that you could get started for like 10 grand. I'd be happy to do it. Can you hear me?
Yeah, we can. Now,
Okay.
Jim, let's see if Jim has a speaker. I'll let him talk too. You're unmuted, Jim, if you want to say hi. I think you might have to make sure you got a mic.
Hey, thanks, guys. Yeah, I spoke to Chris yesterday, and very informative, and I also appreciated the candidness and the no pressure when I'm trying to figure out what to do with the limited funds, you know.
Well, anyway, you can give me a call on that diamond program if you want to, Jim. But I'm going to kind of go over a little bit with everybody, if you don't mind, even though you've already heard this, Jim. But when I got started probably about a month and a half ago, and to me, this was just another one of these dumb programs that somebody sends you an email on. And it piqued my interest because it said it was pretty safe and stuff. And I'm kind of one of those guys that bites at just about every lure that goes by. And most of them, turn out to be junk, and they don't do what they say they're going to do. And so I was a little bit skeptical about this one too. And then when I looked into it, it looked like, I did the trial. And then I did the trial, and honestly, it looked pretty good, but it looked kind of boring. And, I kind of figured it wasn't going to get my juices flowing that much because you don't really make that much money or whatever. Then I figured, what the heck, I think I lost like $5,000 of my normal trading account one day. And I said, I think I need safe. So I signed up for it. And, I started actually making money every day. In a month and a half, I think I've had 2 days that have been down. But what happens is you open up your Robinhood account, you see green. Like this morning, I don't even know what the market was doing, but I looked at my Robinhood account, and I was up like 113 bucks today. And I know that doesn't sound like much, but that's just on one contract that I do on Robinhood. I do a lot more contracts in the Diamond program on my Schwab. But when you get going in the morning and you see like you're up, even if the market is sideways or down even a little bit or whatever, you're not worried that you're going to lose your nest egg that you worked so darn hard for. Jim's a landscaper. I mean, how much harder can you work than doing landscaping, right? And so
that's hard to beat.
Yeah, if you
so you got started in May, right? So let's just take a look at what the market did in May. We can understand why you're losing money in your other account.
Yeah.
So May and June have been wild in the S&P 500.
Yeah,
so I think SPY lost about 7.5. Do you have any idea what sort of return you had in May?
Me?
Yeah.
Okay, I'm not that sophisticated. I just look at my Robinhood account. I started with 30 grand, and this morning I had 33,122.
Nice, Chris.
So that makes me happy. So I guess I could crunch the numbers, but I just look at my balance and it's up. So, and all I do, Jason, is I do what you say, and that's it. And it's super easy, few buttons, and that's it.
Now, Chris is actually using Robinhood. I'll go over some of the pros and cons on Robinhood. If you're pretty confident with trading options, Robinhood's really good because it's super intuitive. They really spell out how to do the trades really easily, and they pay for all your commissions. So it's hard to beat that. What they don't have is a support line you can call up and talk to. So another good option is interactive brokers. And what's important about this is our strategy is, it's trying to make a small return with a huge amount of safety around the trade over and over and over and over and over again. And so in a tiny moment, it doesn't look like you're making a lot, but when you do that consistently, and more importantly, when you don't lose, what's really important about our strategy is we rarely lose. And if we do, we're talking, a bad day for us is we lost $50 a contract. So for those of you out there who do want to follow the program, get started with whatever broker you have, because it takes a lot of time to move things around. You're not going to lose money paying commissions to Ameritrade or anything like that. But once you see it does work, it makes sense to either hop on over. What kind of rates are you paying at Schwab? Are you paying a lot, or you got a good deal negotiated?
I never negotiated anything with those guys. When I trade a stock, it's $4.95, and then, but I get X amount of free ones. But then when I trade an option, I think it's more. But I don't know how much more it is. And honestly, I don't mind if they make money because what the heck, I end up making more.
Plenty of profit in every trade, but the base.
Yeah. So,
really
Jason, one thing I've done with, at least 10 to 20 customers at this point is have them call their broker and just tell them, hey, I'm looking at another brokerage firm that, doesn't charge anything for commissions. Can you all, what can you guys do for me to keep me as a customer? Can you bring me down to maybe $1 a contract? I haven't had a single person that had the broker come back to them that said no. So I mean, Chris, that's something you might want to look into. And especially if you tell the broker you're going to make 150 round trip trades throughout the year with this system, they will absolutely be happy because they're selling your order flow, right?
Yeah.
So they're happy to make a buck aside. So that might save you, heck, a couple $100, over the course of the year, Chris. Probably worth the 5-minute phone call.
Yeah, and the thing about Schwab is they're easy to get a hold of. You're right, Jason. Those kind of brokers are good that way.
Yeah, that's a big benefit for sure.
Yep. But Jay, I found that's easier.
Quick overview of how the 3 strategies work, just for everybody. We're up to about 13 people now. And it's a small enough group today that I feel confident we could unmute anybody who wants to chat. And that way we can hear your voice, you can chat, talk freely, and we'll see what kind of questions everybody has. So right now, we're doing a pretty boring trade that's very, very hard to lose money in. And so let's just take a look at the most recent trade alert in all 3 programs. And you guys will have a good feel for kind of our outlook for the next at least 60 days. And a sample of what one type of trade looks like that we do. Now, they're all very, very similar. But this one's extra defensive. So let me just pull that up. And I'll put it on the screen here. Just give me 1 minute. I'll start off with the basic program. That trades Monday, Wednesday, Friday, right at noon Eastern. I love this thing that my dad says. He says that it takes him less time to do these trades than it takes him to take out the trash. And he's actually in pretty good shape. He's, he bikes every day and all that. So it's not like he's a slowpoke. Okay, so I'm pulling up the 612. All right, so the big fear is that Trump is going to raise tariffs and create some extra volatility in the market. And for us, that's great news. Not only does it make our product really shine compared to everybody else, it actually makes our strategy more lucrative. And so if we can predict that there is a downturn coming, we can make a little bit extra money. And so our goal is to make 1% a month with a lot of safety and very little risk of losing capital. That's really more important. We're much more concerned about not losing than we are trying to gain. And I do note that there's now 16 people, so people keep coming in. Welcome, everybody. We're going to open it up to open mic in a minute. But I would be shocked if Trump does not raise the tariffs in the next. For me, it's the question is he going to announce this before 4th of July or after? And so if I'm wrong and the market heads higher, we're perfectly fine. These trades make a great profit, actually a larger profit than we're used to doing. But if I'm right, we can potentially make more like 2 to 3% a month instead of 1%. So let's just take a look at the current trade and walk everybody through it so you understand all the mumbo jumbo in this trade. So step 1 is you have to buy 100 shares of the SPY. Okay, the SPY is an ETF that's the largest fund in the world. It's bigger than Ray Dalio's. In fact, it's twice as big. And it's just an index product from Spider that tracks the top 504 companies in America. It's the most liquid stock in the world. It's the most important security in the world. And hedge funds, central banks, you name it, rather than going and buying 504 stocks, they don't. They just buy the SPY. So it makes for a very diversified product that is very lucrative for selling covered calls. And it has one more advantage that no other stock has, or ETF. And that is a huge number of option expirations. They expire options Monday, Wednesday, Friday, almost every week of the year. So this is the equivalent of something like owning prime real estate in New York City. Because you're a little guy, you can only afford to buy a tiny condo in this skyscraper, but you know it's part of a huge ecosystem. And so because you own that apartment, now you're going to download something like the Airbnb app and start renting it out for premium, lots of premium. And so when you have that mindset, that's what we're trying to teach you guys how to do. own the best asset in the world, which I would argue is the SPY ETF.
Absolutely.
That's where Wall Street puts its money too, so it's not just me. And then step 2 is we're going to sell covered calls against the asset. And so there's speculators who don't have $30,000 to buy the SPY. They'll pay you between, in this trade alert, they paid us $138 to bet that the SPY will go up by June 12th. Excuse me, that was the trade we closed. Let me go to the new trade. So here's the current trade we're in right now. So this expires June 14th. And in this trade alert, we were able to collect $1.48 per share, or $148, to sell a covered call against 100 shares of the SPY. Now do the math in your head. If you can make 156 trips where you collect $100, that's $15,600 of income from selling call options against the SPY. Now, to be really frank, we're not trying to collect that much money per trip. But in the last several weeks, we've been averaging $2 a share. So as the volatility goes up, and volatility is just a fancy word of saying as the stock market goes down, the prices for options go up. And so the more volatile and scary the stock market gets, rent to get into our shares of the SPY goes up, up, up. And so it's a very simple trade. And if you do it over and over and over again, it's going to allow you to generate a lot of income for the rest of your life just by owning one single security. So we now have people who trust this system with over $1 million because they know two things. Number one, we're going to be very defensive at all times to protect that capital. There's no sense in picking up 50 or 100 bucks if you're going to risk losing 1,000. So you're going to see that we have a very defensive strategy that's very difficult to lose. A lot of the times we might break even. A lot of the times we're only making $25 to $50 a contract. But very, very, very rarely do we ever lose more than 30 to 40 bucks a contract. And at that, I think there's been maybe 3 or 4 total events where we were actually down at all in the last 6 months. So that's why people like the program. It's not about making a lot of money. It's about not losing and slowly, gradually growing your account. So the current trade normally would just be that. We would just sell the call option and sit back. And depending on where we sell this call option can give us some short-term security against our investment in the SPY. But because we have a very well-known risk event in the near future, we're actually going to take part of the profit that we generate from this covered call. We're going to bet down. Here's how we can bet down with a lot of leverage and very little risk. So the first step in this trade alert was to close out the last put option we purchased. And then here's the new put option. Buy to open the June 17, 284 put option. So let's just compare these two trades real quick. The first trade was to buy 100 shares of the SPY. That's step 1. The next step was to sell to open a call option expiring June 14th. And so if we look at the last trading price, it's trading at 288.22 when we entered into this trade. We're agreeing to sell our shares of the SPY for $288, which is 22 cents less than they're worth at that moment. So why would we do that? Because the stock speculator was willing to pay us $1.48. So on his side of the trade, he needs the SPY to go up by at least $1.48 so that he can start making a big profit. So he's trying to turn $148 into something like $300. He wants to at least double his money to go into this trade. And the only way that happens is if by June 14th, the SPY has climbed at least $1.50. In fact, that's where he just barely starts to make money. After that is when he would start to see a profit. And if it doesn't go that high, he's going to lose almost all of the money on that call option. So we'll take a look at how this is performing right now, but this gives you a feel for what the strategy involves. So we've got a guy who wants to pay us $1.48 a share. That's 148 bucks to borrow our SPY shares in hopes that the SPY will jump up by around $2, maybe $2.50 by June 14th. And if he's right, we don't lose. That's what's really beautiful about this strategy. If the stock speculator's right, we win. And if he's wrong, we also win. So it's a setup where the only risk we have is worrying about what the S&P 500 is going to do in the long term. Now, if you think about New York City and having an apartment condo, are you too worried about what the short-term valuation is of real estate in New York? Maybe. It is going to affect what kind of rent you can demand. That's for sure. But in the long run, are you really worried about New York City disappearing? Probably not. Okay, so that's why we don't mind taking the risk of owning the SPY so that we can rent it out. Now, a lot of people will take the same strategy and start applying it to crazy stocks like, say, let's look at one that probably has eaten a lot of people alive. This has been Wall Street's hero trade for quite some time until the December crash last year. Now imagine you're doing this on NVIDIA and you sold your covered call right when it hit 275. And then today, it's almost down 50%. Okay, so that's the problem with this strategy is you don't want to do this on an individual stock that is super risky. You might pick up a really nice yield on one day and then wake up and your asset's worth very little the next. So that's why we want to look at what are the most important stocks, what are the most important companies in the world that we can trust will be around not just tomorrow, but next year, 5 years, 10 years down the road. And so that is why the SPY ETF is the ultimate covered call strategy, because of the security of the underlying asset. You have exposure to 504 different companies, and that exposure is automatically recalibrated for you every day by the fund. There's a reason why the SPY demands more purchasing power in terms of investors buying it than any other stock in the world. There's nothing that even comes close. So that's why the SPY has this huge advantage for being a covered call writing strategy. Okay, so let's go back and look at this trade one more time. So we sold to open the June 14th, 2019 288 covered call for $1.48. And then we took part of that credit and we bought a 284 put option. And so what that does is it sets us up, if the SPY goes higher or flat, we're fine. Covered call generates the profit, put option loses value, but we knew that going into it, and our profit's already calculated before that. SPY goes down, well, the covered call protects us for about $1.48, so the SPY could go down around $1.48, and we won't lose anything because we've covered our shares with that in the money call option, and that credit we receive is our short-term protection. And then we have additional protection by being long a put option. So that's how this current trade is looking. Let's just pull up what these are trading at right now so we can just see how they're performing in real time. And I got a few questions popping in. Let me just take a quick break and see what we got here. Okay, Tess Wong says, is there a reason for Diamond to trade Apple rather than SPY? Yeah, so the Diamond is going to take on more risk, but attempt to deliver at least twice the return. So you'll see why. I'll get into the diamond program and its advantages and disadvantages. So there's no free meal. There are advantages and disadvantages with all three programs. And depending on what your goals are as an investor, you'll be able to figure out what product makes the most sense for you. And for some people, they're following all three. We've got a lot of people who have 7-figure accounts, and they want to put 330 into each of their strategies to really diversify their investments. I got another question from Amsco and Associates. Yeah, so he says, are we going to learn how to do this trade without you? Like teaching how to fish versus just giving us a fish? Yeah, certainly. So to really replicate what I do, the big thing I'm doing for you is really figuring out when there's big risk events that we need to avoid. Other than that, you're going to find the means and the reasons behind the trades are very, very easy to follow. And so when it comes to picking the trade alerts, we're really looking at the put option writing. So let me just explain this to you because you're going to understand the whole program in the next 5 minutes. Okay, so step one is I look at the short-term option market. This is called an option chain. And I want to know where the house, where the casino, where Wall Street is putting their bet. Okay, they've got the most money. If they want to influence the market, they're the ones who can do that. So where are they putting their money? Now, this is not like putting a limit order underneath the SPY, which there's huge limit orders sitting underneath and above the SPY at all times. And that does represent real dollars in these different trading accounts. That's called the order book. But those orders can disappear before the price ever gets hit. Okay, so it's not necessarily a great way to predict short-term movements in the market. But if I look at the option chain, someone asked if we can do this in IRA. Oh yeah, and what's nice about the IRA? No taxes. This is a very, we're generating short-term gains like 3 times a week. So the taxes on this are the 35% capital gains tax. So that's okay, it's fine. But if you're in an IRA, you can compound these profits until you start to make your disbursements and then pay the taxes at the end. So that's obviously a huge advantage.
Yeah, and Jason, one of the things that I've learned, if the person is past the age of 65, they can use this as income, okay, and not pay any taxes at all on it too. So they can make the weekly withdrawals or monthly withdrawals, whatever they need to do. Once you're past 65, you're good to go. There's literally no tax exposure at all. So you can completely use it as a.
But we're not tax consultants. You'll have to consult your own.
Yep.
On that.
Sure.
All right. So let me teach you the secret. There's no huge secret to this. You're going to learn how to fish right now. Okay. So we're going to look at where is Wall Street putting their own money. If you sell a put option, which Wall Street loves to do, they are now on the hook to buy up shares at this price. So we can look at the open interest and where it's piled up. That is where big money is going to have to buy shares of the SPY if we go to that level. So that's where we know we have support. Okay. Now on the other side, so this is the put option side. So we're always looking at where the big pile up is in the put option writing, because we know that's where big money will have to buy the SPY if we go to that level. Now, sometimes we're going ahead and writing it a little bit higher. If we're bullish, we're going to write our covered call above the trading price. If we're bearish, we'll write it below. And so we'll get into that in every single update. I really spell this out for you in the video. Most of the time, I think the SPY will go up. So I want to sell an out-of-the-money covered call, let the asset increase in value, and just pull out free money from these speculators. But right now, that's not the time to do that because we know Trump is ready to raise tariffs and create a shock in the market. So we want to be defensive right now. So we look over here and we can see where Wall Street's willing to buy the SPY. They have to buy the SPY. It's not willing, they have to. And so that's where we know we have support. And on the other side, we can look at where the call options are piling up. And that's where people are going to have to sell their shares if it breaks past that price. So now we know where the resistance is at. So if we're worried about a pullback in the market, we want to sell a covered call at the same strike that there's a huge open interest in the put option market. On the other side, if we're bullish, if we think everything's fine, we're just in for a nice steady grind higher, then we're going to want to look at where there's a huge pile up in call options and sell it right above that level, because we know it's very unlikely it'll push past through that. So in general, that's how we decide where to write the strikes. And in general, we're not going to reinvest part of our profits in this put option. It's basically like throwing money into the toilet most of the time when you buy put options. But this is a rare setup where I'm very certain that there's a high level of risk in the next, really in the next 6 weeks. So for the next 6 weeks, we will take some of our profits and buy insurance. And so that's what this trade's doing right here. Yeah, I believe it is being recorded. And if not, we'll be doing this every week. So you can hop on. Now we do have 2 webinars. We have one that's for free, folks. That's what this is on Thursday. And then we have another that is only for our paid members. Little smaller group. We can get a little more advanced in what we talk about. And of course, we're not going to have to repeat, hey, here's how you do a covered call to start those out. So the second you do upgrade your free trial, you're not going to be invited into this webinar. You're going to be in the webinar with all of our paid clients. Okay, I got a quick question from, and we're up to 21 people. Welcome, everybody. We've had people consistently joining in. Okay, I've got a new question from Lima. Can I see on the chart the call and put and explain what will be my win in both cases? Oh, okay. So yeah, we wanted to look at how we're doing on our recent trade. Okay, so I can tell you right off the bat, the SPY has traded higher. One sec, guys. I'll be right back.
So Tess and Ethan, this is Dean. Great questions. Just wanted to tell you that. Appreciate those. That's awesome. You guys are definitely starting to figure it out. And Ethan, the other thing with Jason is after you see this time and time again, you'll start to learn exactly why he's positioning where he is. So yeah, you'll absolutely learn how to to fish. Learn the technique, and we're gonna help you anytime you have a question.
Okay, I'm back. Thanks, Dean. So yeah, so just looking at the chart, I can tell you what's happened, and then we'll look up the prices and we'll evaluate it. But the SPY's gone up. So we know the covered call is doing its job. It's going to generate that profit. The put options lost value. So this is a setup where the covered call made money, the put options losing value. So let's just look at what our profit was right now based on where we're at. And this way, you guys will learn how to evaluate these trades on your own. We'll close out our trades from earlier. All right, so here we have our two trades. See if I can get both on the same screen here for everybody. Now, it's important to remember the main way we generate profit from this is from the time premium and the call option losing value. So most of that profit is generated in the last portion of the time that the option was written. So tomorrow we will really maximize the profit on the call option part of the trade in terms of the time premium decaying. So we can see the put option has lost 30 cents, 32 cents, and that's fine. That should be expected. This was to protect us in case there was a market shock. Okay, so we're down 33 on that. And now this is going to be what confuses most people in our program. So we sold this covered call when the SPY was at 288.22 for $1.48. To buy it back right now, we'd have to pay $1.95. So we'd actually lose 50 cents on that. So where are we making a profit? Well, let's do the math. So the current value of the SPY is at 289.58. And to currently buy that back, we would have to pay $1.95. So I'm going to subtract. First I'm going to subtract the price that we entered the trade at. So that's 288.22. Okay, so we're up $1.36 on the SPY. So again, you can just look at those two prices. So we're up $1.36 on the SPY. I'm gonna have to give him back, what is that, 46 cents. So I'm gonna subtract the 46 cents it costs to buy that back. So now I'm up at 90 cents. And I'm gonna go down to the put option. I'm losing 33 cents on that. So we're up $57 a contract. Now what's $57 times 3 times a week times 52 weeks? That's $8,892 a year with this very, very boring trade. Now a lot of people want to know, well, what if the SPY went down? Well, guess what? We're going to be able to buy back our covered call for a profit, not a loss. The underlying asset won't have gained the value, but the covered call did gain value. And guess what's going to happen to this put option? Its price is going to go up. And so you can guess the future price by raising up the strike a few notches. And that's what this put option will head to every dollar we go down. Okay, so we're in a setup that's very hard to lose. You're not going to make a lot, but you're sure as hell not going to lose a lot. There's a very small window where we have risk, and that's around the 288 strike price minus the $1.48. So we're protected down to 286.50. Okay, but then if we go any lower, we're now protected by our put option. So this trade's weakness is probably only between 286 and 286.50. And if we trade in there, we may have a break even or a tiny, tiny loss. If we go any further, that put option starts to scream up higher in value. So that's the name of the game with this program. So of course you don't want to give up any profits that you don't have to option to the broker dealer. So you definitely want to get that cost per trade down. But even in the worst case, usually you can get in and out of this full setup for less than 10 bucks. So if we're pulling 57, even in the worst case scenario with your current setup, with your current broker dealer, you're only giving up a piece of the pie, not that much. Now you go to an Interactive Brokers, they only charge 25 cents a contract.
Yeah, and to just make really things incredibly simplified, guys, all we do is we engineer downside protection. Okay, so when the market does drop, we use the option premium to offset our losses. Okay, if market's flat, we just collect option premium there. The market goes skyrocketing up, we're not going to make as much as the market, but it's the downside that hurts everyone, right? And it's a downside that keeps you up at night. So I always joke with Jason and say we should call this the pain-free stock system because that's exactly what it is. But that's kind of the general basis overview, kind of really dumbed down for you too, just so you kind of have a map there in case you're getting lost.
Let me take a look. Tess want to know, what's the point of Diamond? Why would it trade Apple? Good point. And I want to show you something. What exactly are the top companies in America? That's a good question. Where is the SPY ETF invest your capital? And here you go. Who would have known the biggest position in the SPY is Microsoft? Okay, so normally our Diamond program trades a basket of the top 8 companies in the SPY. But right now we've solidified the portfolio only into Apple. Why Apple? Why not Microsoft? Well, let me pull up those 2 charts and you'll have an idea. In terms of buying and holding a stock, I love Microsoft. And the next time we do get a crash, you better bet your bridges we're going to go in a big position in Microsoft. We had a 4% gain in the Diamond program doing just that just last week. We got rid of the covered calls because we saw the sell-off was over. We saw that Powell was going to hint at lowering rates. The market's rocketed higher. So we love to buy and hold Microsoft, but its volatility is actually less than the SPY. It's just an insane company that has very little competition. And so when I skew it down and look at the long run, it's had very few pullbacks. And when it does have pullbacks, its pullbacks are less than the general market. So this is one of the least volatile companies in the world, has the largest market capitalization. And to make things even better for it, 4.5% of all the capital that flows through the SPY automatically flows right to Microsoft. Okay, so they have the most cash to buy back their stock. They have the best credit rating to borrow money for whatever they want. They can buy out companies with their shares and the stock will just jump in value on the announcement. They have top position in every hedge fund around the world. They have top positions in the SPY ETF. They have top positions in every central bank. This is the safe stock, okay? So we don't make a lot of money with covered calls on Microsoft. And even with all the trade wars, do you see much volatility in it? Not really. Let's take a look at Apple. Whoa! Just in the last 18 months, this puppy has flown up and down. That is a option writer's dream come true when you have 2 things. Number one, you know Apple's not going to disappear. Okay, we know NVIDIA is probably not going to disappear either, but its revenue and its market cap is a tiny peanut compared to this whale of a company, Apple. Okay, so Apple has a lot of volatility for good reasons. Its supply chain is right out of China. A lot of its sales are in China. And because America's attacking China's Huawei, this is the logical company for China to attack right back at. So why would we want to own such a high-profile targeted company? Well, we do know that it's the second spot in the SPY ETF, so a lot of money is going to automatically flow to Apple. I think they're sitting on some $1 trillion of cash. That's always nice. They can buy back their own stock. Warren Buffett's #1 position, what is it? It's Apple. Almost half of his entire stock portfolio is Apple. Okay, compare that to Amazon. 1% of their portfolio is in Amazon. So Apple has a lot of good things going for it. It has the moat around the castle. It has a proven business. It has people who will never, ever leave the iPhone. They're getting ready to move their manufacturing chains to India to get around this mess. And more importantly, because of that huge crash in the last year, the option premium is insanely expensive. So people who want to bet Apple's going to jump back to its recent high, you can't bet Microsoft's going to go back to its recent high. It's already right back to the high. Apple has another $35 just to get back to its recent high. So you can bet that there's plenty of speculators who don't want to go throw $195,000 to buy 100 shares of the Apple. Or sorry, $19,500 to buy 100 shares of the Apple. They would rather buy the call option. And so for us, that's a great setup. So let's take a look at the current trade we're doing on Apple right now. And I do want to point out, if you do end up upgrading from a free trial on the basic program, we're going to throw in 30 days free into our Tuesday class, which we call the Diamond Club. Takes a little bit more money to build this total portfolio. But right now, and until the trade war is over, we're going to be trading just Apple. And I got news for you. I don't think the trade war is ending anytime soon. So if you are holding on to equities, watch out below. Make sure you have some good hedges to protect yourself. So the current trade we did on this one, let me pull up the chart or the trade alerts. We can look at the exact document. Okay, sorry about that, guys. Okay, here's the trade alert from 6/11. I'll also pull up the previous trade, 6/4. Okay, so 6/4, we had the trade alert to sell all the covered calls and just go long the stocks. And so normally our breakdown is 300 shares of Microsoft, 100 shares of Apple, Facebook, Intel, Cisco. And again, we're just looking at what are the top holdings in the SPY, because we know the SPY is going to take that cash and automatically buy these companies. So we know there's great demand for these stocks because they're the top positions in the SPY. Now, we did weed out Google, Amazon, and Berkshire because that would take the cost to build this portfolio way higher than this group of stocks. And that's what our Thursday class is all about. The Whale Club, it picks up Amazon and Google. It does leave out Berkshire. I'd rather just rebuild Berkshire because almost all of its assets simply own Apple, Bank of America, and Wells Fargo. So that basically is what Berkshire holds. So we went long, and our profit at that time was sitting at 9.98% based on a $150,000 portfolio. By 6/11, we had a record-breaking return in the stock market. It was going up way too fast. Nothing made sense. We really hit a home run. The trade alert was to take the money and run. And so let me see where the profit shot up to. So in that week, just in 1 week, the portfolio gained 4%. So we went from a profit of $16,637 to a profit of $24,510 just by buying and holding that group of stocks for 1 week. Now, that's not a normal return, but it just goes to show when you own the most important assets in the world and you have them during the right periods of time, it can be very lucrative. Now, the new trailer was not trying to take so much risk. And that was right after the Fed meeting that we decided to make that call. So today, or rather Tuesday, the follow-up trade was to go all in on Apple and to do this setup. So let's look at the math. Here's how you calculate the math on these type of trades. And I'll just type it right below. So the last price when we entered this was $194.55. And we're agreeing to sell our shares for $1.8750, which is going to be a loss. So let's see what kind of loss we walked into on this deal. That's negative $7. Why would we do that? Because we're going to get a credit of $8.50. So now we're up $1.50. Okay, now what did we do with that $1.50 profit? Now this is assuming Apple goes higher. We get assigned. What's going to happen? Well, we're going to make that $1.50 a share. But we didn't take the $1.50 and just keep it right there, which is $150 a contract. We reinvested $1.15 a share, or $115 a contract, into put option. Okay, so what are we trying to do? We're trying to catch a down move for free. So we're letting a stock speculator, he wants to bet, you know what, I think the China-US trade war is no big deal. You know, how silly. They've got to make a deal. Trump's going to get his election going in November 2020. He's got to wrap this up. That's what they're thinking. So they're thinking, let's buy a call option and get rich. Okay, what we're thinking is, well, maybe that won't happen. If it does, great. We don't lose. We make money. But what if that doesn't happen? What if things escalate? Okay, now we have a leveraged put option that can generate a huge profit. So this is how we're allowing the stock market to pay us to have a multi-directional profitable setup. Apple goes up. We're going to make 35 cents a contract. Apple goes flat. We're going to make a little bit more. The put option won't lose all its value. We'll be able to sell it next Tuesday, keep some of that, the profit goes up. Apple goes down, a little harder to calculate, but in general, we have $8.50 of protection from the covered call. So already Apple's going to have to go below 179 for us to feel any pain. So it's got to drop $8.50 before the covered call stops doing its job. But what's going to happen when the 182.50 put option we bought starts to get closer and closer to the trading price? Well, that $1.15 that we paid to buy that put option is going to skyrocket up in value. So we'll actually make an extra large return if we catch a downside move in Apple. So it's simple, it's easy, it's repetitive, it's safe. And that's what we're doing until the trade war shows signs of de-escalation. Now, if it does show signs of de-escalation, we'll go right back to our nice diversified portfolio of stocks, and we'll evaluate what makes sense at that time. But I would be extremely shocked if we come out of July with a trade deal, or even a truce, or a delay. I think that the time is now. He has to take action now before he does run out of time for the election. And if we do look at the option chain, once again, where's Wall Street saying they can buy this stock at, or where do they have to? Okay, so we went one strike above that. but it's at the 185. There are 78,924 open contracts at the $185 strike. So if we get anywhere near that price, that's $1.3 billion that's going to have to buy Apple. It's probably not going lower than that, not unless there's a huge, huge sell-off. And so that's how we pick the strikes. Any questions real quick, and then we'll jump into the whale program. I'll take a look. It's the same setup, but now we're doing it with Google and Amazon. Any quick questions out there, guys? All right, well, let's just take a look at today's trade. Normally I wouldn't publish that, but we'll let you guys take a look at it. Okay, Tess says, how do you pick the strike price for the call? Okay, so I look at where there's large open interest on the put option side, and then I go right across and I write the covered call right there. If I want to be defensive. If I want to be offensive, I'll do the opposite. I'll look at where there's a large open interest on the call option market and sell it right above. So on the put option side, that's where we have support. And on the call option side, that's where we have resistance. So we want to be above or at the open interest level on the put options if we're being defensive. And if we're trying to bet the market will go higher, then we want to sell one where a lot of people are going to sell before us. So like in this example, if I wanted to be bullish on Apple, I can see there's a huge open interest at 200 and an even larger one at 220. So depending on how much risk I want to take, I might say, okay, well, to get through this, we're going to have to sell $750 million worth of Apple at $200 a piece. So that would take a pretty large buy order to break through that price. So if I go ahead and sell this dollar covered call at the 202.50, I'm probably going to be able to realize the underlying asset go up in value. And the call option I sold most likely will never get anywhere near its strike price. So it's just going to lose value. So I'll get a double payday. On the other hand, if I'm worried about the downside, well, right here at 185, there's a huge buy order. There's 78,000 shares or contracts that will have to purchase lots of 100 shares of Apple if we get to that level. So that's why if we're defensive, we'll write a strike either at that price or right above it. And in this case, we did it right above it. Does that make sense? Yeah, sure. So at the end of the day, we're giving up the potential to profit from upside moves and creating a scenario where we win in a lot of different outcomes. And the exact, metrics is hard to stipulate, but there's a tiny, tiny band between where we buy our put option and where we sell our call option, where we can possibly lose a little, not a lot, but a little. The rest of the scenarios, we make money. So it's a lot like being an investment bank, not trying to speculate. We're trying to pull out the easy money from the market and mitigate risk. All right, let's take a look at our whale trade. Okay, Jim says, so the best way to grow the portfolio is diamond. Yeah, if you want the most, let's take a break. So whale program is doing the same thing, guys, but it's doing it with Amazon and Google. Let me characterize the three portfolios so that you can get a feel for what makes sense. Basic program, aiming for 1% a month. Sometimes we do a little better, but it's really not trying to set yourself up to make any more than 1% a month, okay? It's trading pretty frequently, Monday, Wednesday, Friday. It's very hard for it to lose money because of the way it operates. You're aiming to make around $50 a contract 3 times a week with a lot of downside protection. You have to be willing to be a little more active. The trades only take 2 minutes, but you're still trading 3 times a week. Your underlying asset is for sure the most important security in the world. There's nothing that even comes close. So people who are very attracted to the basic program tend to be folks with a lot of capital because they don't want to lose money and they're happy generating a small return consistently. Okay? The diamond program is more aggressive. To be more aggressive, we have to take bigger risks. This program is aiming to make 2% a month. So guess what? It's going to have to take greater risk to achieve those types of returns. And for example, in the month of May, it was down at the peak about 3.5%. And that's against the stock market losing closer to 7%. But guess what it did last week? It went up 4%. And it's on track to make around another 0.5% this week. So it takes more risk using the same strategy to achieve a bigger gain.
Hey, Jay, can you scroll up a hair just so they can see the ROIs?
Yeah, there you go.
Thank you. Yeah, perfect.
Okay, so Diamond Club will take more risk. It only trades once a week. And right now it does cost less to follow it because you only need 100 shares of Apple. And most likely that will be the trade for quite some time. Now, if you did want to follow the diamond, even after we rotate into the big basket of stocks, guess what? Go with Microsoft. This software is programmed so you can turn off different sections of the portfolio. So you could turn off all of these and just follow the Microsoft trade. Right now, Apple is extremely attractive because of the really high covered call income we can generate. Sam says, can I use TD Ameritrade? Oh yeah, most of our clients, I mean, they're one of the bigger brokers. So a lot of people are on Ameritrade. Okay, so Diamond Club, bigger risk, bigger return, less work. Aims for 2 to 3% a month. To do that, you're gonna have to take a little more risk. Now, when I talk about taking risk, it's a lot different than what you're used to. Because even when we do take on more risk, we still have defensive covered calls protecting the assets. So this program in no way is just out there winging it, trying to get lucky. It's still selling protective covered calls to protect the underlying asset and still generate profits in 3 directions. Whale Club's a little different. Whale Club, you need 300,000 to follow approximately because you're going to need 100 shares of Amazon and 100 shares of Google. Okay, its setup is exactly the same as the Amazon program, but now we're specializing in trading Amazon, Google, and when those are not at attractive levels, which means they're at a bargain price and volatility is high, the rest of the time it's trading the boring TLT. And so what's nice about the TLT is, well, a few things. Number one, it looks like the Fed quite likely is going to have to start monetizing its debt. And that means we're running out of people who want to buy our debt. And the rates are getting so low that the only people who are buying it are just trying to make a quick profit on the bond market. So my expectation is either the rates jump higher because everybody starts to realize we cannot afford this level of debt, or the Treasury starts to monetize the debt. And all that means is they're going to start making the interest payments by printing money. That's going to lock in these rates in a very narrow range and allows us to safely do the same trade setup whenever it's not attractive to trade Amazon and Google. So this one will basically just rotate between the TLT and then Amazon and Google. Now the Whale Club does require having a larger capital, but it's more patient and it's going for smaller returns. So it's more attractive to very large portfolios who want to take advantage of markets that most people can't afford to get into. Okay, let's see if we have any new questions. There's no bad question, guys. Please, this is our beginner level webinar. Again, once you do upgrade, you'll get moved into a different group. Yesterday is our paid member webinar. where it's just people who've been in the program who's a paid member. And so you're not going to upset somebody with a newbie question is all I'm trying to say.
Yeah, and Jason talks fast, right? I'm sure you all know that. So please feel free to ask some questions. I do it on a daily basis, so don't feel bad, don't feel shy. It's really okay. Anything you have is a question. We're more than happy to help you guys.
I'm going to try to unmute everybody, see who's got some audio. Jim's saying, is this being recorded? I hope so. We just switched platforms. I don't know if I hit the record button or not. But this will be every week, Jim. So, okay, Howard has a question. When you sell a call on the money, when does assignment happen? Okay, so that's a great question. Option assignment happens overnight when the market's closed on a lottery basis. So there's no guarantee that you will be assigned. And at the end of the day, for our profit loss, it won't change. The profit you have to the upside is locked in the second you sell that in the money covered call. And there's no way to get around it. The profit you can make will be the same if you cover the covered call the next day for a loss and realize the profit from the underlying asset, or if you're assigned. Now, if you're assigned, whatever strike you sold it for, you get that. Plus, you get to keep the entire option premium. It works out to being exactly the same. Now, the only difference is there's going to be a window in the morning the next day where you don't own the stock. So now you're out of the market. You made your baked into the cake profit. That's what I call it. Okay, Lima says, what are our prices? And so, yeah, we have a really nice deal right now. Normally, the basic program's $2,000 a year, but we do have a deal over the phone to save $1,100. So definitely call up Dean and Chris if you want to save, because we're not going to let that offer go for much longer. It's really just a summertime deal. People, for whatever reason, are a little slow to pull the trigger when they're traveling and things like that. So we're making it very lucrative to pull the trigger right now. And then from there, we do have more advanced programs, but you're going to get 30 days free to try those out before you make the call. So that's just the kind of the breakdown on how to get started with that. Daniel says, why not the SPY and TLT in the basic? Yeah, the TLT is boring. So let's take a look. This is what we did for 6 months in the Whale Club. Traded that TLT over and over and over again. And we told everybody we're waiting patiently for Amazon and Google to have some volatility to get a good sell-off. Not only did the total market sell off, good old Trump announced, well, not him, but the FTC and the Department of Justice are opening up antitrust lawsuits against Amazon and Google, which is probably no big deal. I mean, this has happened to Microsoft. They had emails from Bill Gates telling his staff to crush the competition and get every ounce of oxygen out of their lungs, like just ridiculous stuff. So yeah, I mean, we know Amazon and Google are not going anywhere. Google definitely has a monopoly, but Google's only paying $23 million a year right now to lobby for lobbying efforts. So their ability to manipulate the government for cheap is just incredible. Okay, David, is there a possibility? Okay, so in general, though, the SPY has a lot of advantages if you're willing to have a little more risk. Bond market is less risky than the SPY. So the SPY is more fun, higher return, more action-packed. We got to do it 3 times a week. And this is our most popular product. People love being able to protect their capital 3 times a week and see the profits 3 times a week. The Whale Club's a little less of a, how do I say it? You have more patience and you're really willing to wait for great opportunities. The sort of folks who tend to buy our basic and diamond program, their sophistication is relatively new to stocks and options. and their trust level with me is low. They want to see results immediately. There's no waiting. They want to see results right now during their free trial or they're out. And so that's what those products do very well. You can make money during your free trial. You see it's the real deal. Whale program, I'm asking investors to really trust me and be patient. There's a lot of boring trades. The TLT is the boring filler trade while we wait for big opportunities on Amazon and Google. So that's kind of the difference. And the pricing's a lot different. So the folks I'm helping manage in the whale program have very large portfolios. So they're really happy to pay a premium if I can protect their assets and generate consistent returns. Okay, David has a question. Is there a possibility of being flagged as a pattern day trader in the basic program? So I think that's if you do, well, you're going to have enough capital to be okay on that with that program, I believe. But I think that's if you do 3 trades in a 72-hour period.
It's intraday, Jason.
Okay. So yeah, I think you'll be all right on that because the most we trade into a single day is in and out. It's only 1 round trip. And I believe you'll have enough capital to not be worried about that with the requirement. We've never had anybody complain about that in our program. Okay, do I need to have 2 accounts for options and for stocks? And what is the minimum account for both of them? No, it'll be 1 account. And yeah, so you want to have at least $30,000 ideally so you can follow the program with no leverage. I mean, why borrow and pay 5 or 10% a year if you don't have to? So I would try to have a $30,000 minimum account size, but most folks following this have a lot more than that. The people who really are attracted to this usually have around 100,000. That doesn't mean you can't grow a smaller account, but the people who are really attracted to this tend to have a little bit larger account. Daniel says, is the basic safe enough for a retiree's IRA? Oh yeah, this is way more safe than what you're doing right now. I'll tell you that. If you're long stocks, good luck. That's my message to you. If you own any stocks, good luck. We have a very high level of risk in the next 45 days, and you're going to want to be following this program, not with part of your capital, with all of your capital, because you're going to see what we don't do is lose. We may not hit the big gains when the market goes higher, but we're going to give you the downside protection so you can sleep safe at night. Let me see if I can unmute some folks and hear a few voices. If you don't want to chat, no problem. But if you do, it's always nice to hear people's voices. Okay, I'm unmuting everybody. If you want to chat, you're going to have to click the microphone that's probably muted on your end and unmute it. Now, a lot of people don't like to speak, no worries. But if you do want to say hi, please go ahead. We're running out of time, so this will probably be the last few minutes we have together today. Anybody want to say hi? Lima, how do I say your name? I know I'm not pronouncing that right.
Hi, you're pronouncing very right. My name.
Oh, good. Well, hey, good to hear your voice. Anyone else want to just say hi?
And Howard Davidson, I wanted to make sure we addressed your question. Did that answer everything that you were wondering about?
Can you hear me?
Yeah.
Well, how far is too much in the money when you sell a call?
Yeah, so the farther we go in the money, the less profitable the trade becomes, but the more protection you get. So there is always a limit to the point where you basically won't have a profitable scenario. So yeah, I'll pull up an option chain so you can see that. Let's just look at the SPY. So, you know, there's no free lunch. If we want to have protection, it comes at the cost of making less from the covered call. Okay, so in this example, let's see how far, you can go pretty far without having a losing proposition. And let's go to a little farther. We'll go to tomorrow's expiration. All right, so it looks like we can go, the last trading price, 289.47. So right about the strike. If I go all the way to here, let's just see, I think that's about a break even right there. So if we compare the last price to the strike price, I'm agreeing to about a $5 loss to pick up $5.11. So, you know, if you're paying $10 a contract, you're going to break even. Why would you do it? If you're getting paid, if you're paying your broker nothing, like Robinhood, you make 10 bucks. It's still not that great. You know, at 10 bucks, if we did $10 a contract 3 times a week, 52 weeks a year, we're looking at like a 5% return. Hey, it's better than what the bank will pay you, but it's not that great. Now, if I push up the strike a couple, like $1, now I'm making closer to 30 cents. A little more attractive, still has good downside protection. If I go right at the money, let's see what kind of potential profit. Now I can make around $1. So in this instance, I can make $1 plus. Okay, so on this one, I make $1.10 on the call option. Plus, I'm agreeing to sell it for 20 cents higher than it's worth right now. So now I can make $1.30 or $130 a contract. But what was the risk? Well, now I have no downside protection. I only have $1 of downside protection. So it all comes with reward and risk. There's no free cake. So the strategy we're doing right now is to sell it pretty close to the money covered call, because we get a very nice premium, and we're taking half of that profit that we can make if the market goes higher, and we're buying that put option with extra duration. Okay, why not buy a leap 2 years out with a 0.8 delta? Okay, well, why would you want to buy a leap option? I mean, I think stocks are going to go flat for next year, and so it would lose all its value. So again, we're in the business of not speculating that stocks go higher. Let's take a look at, let me show you guys what happened last time we had a Cold War with Russia. Okay, in your portfolio, you know, look at this. 1964 had 2 recessions leading into it, just like we had in 2000, 2008. Market was flying high, everything's looking great, and then we go to a Cold War with a lot of government spending, all kinds of programs to help out folks. We go into huge debt, we get runaway inflation, and stock market crashed from 1966, 65 until 1982. In fact, it wasn't even back to even until 1995. So how's your call option going to do during that kind of setup? We're going into the same setup. We're going into a Cold War with China. So we need a strategy that's not relying on stocks going up. We need a strategy that's just taking the money from foolish gamblers. The foolish gamblers want to buy call options, betting the SPY will go up in 48 hours. Okay, so we're the piggy bank. We're loaning out shares instead of dollars. The loan pays the interest. We can do this over and over and over again. All right, guys, last chance for a question, and we'll have to wrap this up. We'll have another one next week. You're welcome to join these an unlimited amount of times until you're confident that we can deliver what we promise.
Can you hear me?
Yeah, I can hear you.
This is Daniel. I had a couple of questions. One, you push Robinhood, the brokerage. of choice because it's trades are free. But I've heard that they don't deliver the best execution in terms of price performance or price improvement, and that's how they make their money. It's how they can do it for free. Do you have any comment on that?
Well, everybody fills through the same liquidity providers, and what they're actually doing is selling their order flow to hedge funds. So sure, I would say really my favorite is Interactive Brokers, because not only are you going to get the phone support, you're getting next to free prices, and you can put your IRA over there. So that would probably be my favorite. In terms of liquidity and the spread, I mean, the spread on the SPY is usually like 2 to 3 cents. So yeah, I haven't had any problems with the prices from Robinhood. The biggest downside to Robinhood is, number one, no phone support. So if you're not pretty good at options, you're better off at Interactive Brokers. Two, they don't do IRAs, so you're not going to be able to move your IRA over there. So a lot of advantages to Interactive Brokers.
I've got my
Robinhood,
IRA.
I mean, we got people who love Robinhood, but again, it's like a chat support. There's not someone you can call. We're working on getting a better relationship because their typical client has like $200. It's millennials. They're the fastest growing broker house in the world, funded by the San Francisco private equity giants. So, that's who's paying for the trades. They're not trying to make money. They're really just trying to have the best deal in town and steal the business away from the market. But because their target audience that's been attracted to it is millennials with $200, they can't afford to pay, a licensed stockbroker $50 an hour to support you if you only have $200 in your account. So we're working on getting a dedicated line because, our clients all have 30,000 or more. But yeah, if you want to play it safe, Interactive Brokers.
The IRA right now is at Fidelity, and there it's a $10 round trip on each trade. So
yeah, call them up.
Yeah, call them, Daniel.
Move into Interactive Brokers unless they match, and go to the fee page with them. And they're either going to let a large account go, and if so, screw them. If they don't want to win your business, screw them. But most people can get the rates way lower, especially when you tell them you're going to do 156 round trips on the SPY. Yeah, they're not going to lose that business.
Is there any service that does auto trading based on your calls? I ask that only because I travel a lot, and I'm not always by the computer, but with an ability.
So yeah,
trade.
I would recommend you do the Diamond program Tuesdays only. And so you only have to worry about being at your computer at noon on Tuesday, and you can follow the program easily. We are working on a phone app, but that would still be semi-automated. We can't legally trade your programs for you. I know people do that, but it's really stupid. It's a good way for everybody to get in trouble. So yeah, right now I would recommend the Tuesday Trades Diamond program. It's a quick trade. A lot of our folks are always on the road. They love that that's once a week. And it's very similar to the SPY, but it's just pulling the best of the best out of the SPY and focusing your assets on. And there's a good argument that those top companies are actually safer as a portfolio than the SPY because those companies are gobbling up all the competitors underneath them. So there's arguably a lot of junk in the S&P 500, despite having that huge amount of diversity.
I think Apple is a value stock, and I've owned it since it was priced at about $55. I made several 100% on it. How much capital do you need for the Diamond program?
The Diamond program is currently trading Apple, so you'll be able to follow that with $19,472 right now.
Oh, cool. So I've got about 50,000 in Apple right now.
Yeah. A lot of people already have the trades. They're exposed to too much risk for their age. So 10 years of doing this, I was the guy teaching finding the people who had 20, 30-year history of trading stocks. They all thought to provide value, here's what I got to do. I got to beat the market. Okay. That's where most people mess up. It's very hard to beat the market. Okay. So that's one. And then two, our strategy, we're not trying to beat the market. Our strategy is a lot more like being the market. We're just copying what Wall Street's already doing and sucking out the profits from the option market.
Do wash sale rules come into play when you take losses and then you meet it, 2 days later or a week later, you repurchase the same equity? Does that apply to the SPY and to Apple and so forth? I mean,
yeah. So if we get assigned, that's a great thing. That means we hit our maximum profit on the trade. So then you'll be in cash until the next trade. So that's really nice. Now, people who do the opposite, it's not so hands-free. If we try to replicate what I'm teaching you, a lot of people are like, well, oh man, I don't want to buy 100 shares of Apple. Why don't I just write a put option and do the same thing? It's not the same risk profile. It's not the same setup. And when the disaster happens, you're going to end up owning Apple one morning for a huge loss. So in our setup, the worst case scenario is actually a great one. We're out of the market. We got paid for our shares. We keep the call option premium. And that's it. You wait till the next trading day and you sit in cash until then. Very simple.
So you don't have to wait for 30 days if you have a loss to repurchase the stock?
No.
Well, we wouldn't have a loss. There's no way to lose when you sell a covered call and get assigned. So,
okay. Yeah, sorry. Okay,
Oh,
thank you.
Yeah, that's right. That's right.
Sam, are you out there? You got a question, buddy?
Can you hear me?
Yeah.
Oh, okay. I was just,
Your dog or something. I'm just kidding. I don't know.
I'm just talking to myself. Thank you for making this program available for us today, and it clarifies a lot of the buy and sell position levels in the option strategies.
Oh, sorry. What was the question, Sam?
Oh, I'm sorry. I don't have a question. I was making a comment.
Oh, okay, great. Well, hey, thanks for your kind comment.
It's just thank you for making the program available for us today, as it clarifies buy and sell position levels and option strategies. I'm looking at things different now.
Yeah, this is, I think it's pretty easy to understand. A few big benefits. What I learned from trying to sell other gurus over the past decade, it was a great experience. I would never take it back. But number one, they're all trying to beat the market. They thought to provide value, I have to outperform the S&P 500. Good luck. Almost no one can do that. Even the brightest minds over the long run,
right.
They underperform the SPY. So right off the bat, we already know we can fire just about any so-called stock guru who thinks they can outperform the SPY. You think you can outperform the SPY, you're crazy. That's number one. Number two, even if they did have streaks of luck, good luck trying to figure out what on earth they're doing. Okay, they're pulling trades out of their ass left and right at random times on little equities that are flying up and down in price. No one can follow it. Good luck. Okay, so those are the two biggest things that I saw were the problems. And then when I figured out the audience who really needs this are people going into retirement who cannot afford to lose a penny. They need to play it safe. Okay, so that's where our audience really falls into the bucket. They need to play it safe, but they need to generate a consistent return. So if that's you, you're not going to find a smarter way to do it. And we're basically teaching you how to copycat what Wall Street's doing and just be a little parasite. Just eat away at their profits. Follow the money.
Hi, this is Dave. I have a question.
Please.
Yeah. So I guess even if the SPY drops, you're always going to have that underlying put as the protection for the downside, right? So let's say it drops off the map, you're really not losing money in the SPY if you've got that put
Yeah, so we have a very, very automatic reaction to the SPY dropping. Okay, so two things. Number one, if the SPY drops, the covered call we sold loses value. And because we're the writer, the underwriter of this contract, that's good. That means we can buy back the contract for cheap. So the covered call will protect the downside to a degree. Okay, but it's not going to protect 100%. And so you're right. To really protect against deep moves on the downside, the put option is very important. Now, right now, the VIX index is relatively high. So the option premium on the SPY is beautiful. The more volatile the market, the better it is for us. But you'll see as volatility gets low, we can't afford to have so much downside protection. So you'll see the strategy does evolve as the market adapts to what risks are ahead. And right now, anybody who reads the news knows what the risk is. Trump is going to raise the tariffs and the trade war is going to escalate. And if you don't plan on that happening, you're going to wake up feeling pretty sad by the end of July. Now, if I'm wrong, we don't lose. We make our same boring return right now.
So to follow up question two, because I'm kind of in the same boat with some of the other people, I work during the day, and what you're saying is I've been following along on the free 1 week trial to make the trades. So as long as I'm making the trades before the end of the day, the ratios might be different than yours, or the strikes might be different, but the ratio might be the same. Is that right?
Yeah. So you want to pay attention to the strike and the expiration date. The credit you receive is not important because the strikes are chosen. Go back to the mindset. Hey, let's just be a little parasite jumping in on top of Wall Street. So that's what I'm really showing you how to do is be a parasite, eat away at Wall Street's profits. So yeah, the credit is fair relative to the current price on the SPY. But the reason we're picking those strikes is not because of the amount of the credit. We're picking those strikes because that's where Wall Street has to cover their position and typically buy about $1 billion worth of the SPY. Now, I'll tell you what happened. In the last few weeks, the SPY went from having about $1.3 billion buy order underneath it, and that evaporated. Now there's literally less than $250,000 underneath it. So that's a good wake-up call that there is added risk below us right now. And that's why we started buying those put options.
So the timing isn't critical to make the...
No, and you can get these trades in usually an hour or more after the market closes with the SPY. It's a very unique product. And Dean was even saying that you can trade it throughout the night. So yeah, a lot of people get the trades late. They're not time sensitive. The same day, you're fine. Now, you do know exactly when it hits. That's a very important part of our product is people need to be able to rely on the timing of the trade alert. So we have a whole team that goes into this production to make it come out at the exact same time so that it's very predictable and easy to follow. And that's probably more important than the strategy itself, is the ease of knowing when the trade is going to occur.
Thank you.
Oh, you're welcome. That's a great question.
I have a question.
Would you not do that?
Oh, we got some more people in here. I'm unmuting you if you want to speak. You just have to hit your button.
I think I just burped and everybody heard it. God,
Any other questions out there, guys?
I'm such a thing.
And don't forget, this is a weekly webinar. You can attend it an unlimited amount of times. And this is for our free group. These are people who have not yet decided to join. So there's no reason to feel bad about it. Any kind of question, as basic as it is. Yesterday was our paid group. And so that's where we get a little more advanced into talking about strategy and technical aspects.
I have a question.
Sure.
So we will be learning to read charts, correct? In your program?
I'm sorry, can you say that one more time?
In your program, we will be learning to read charts, how to understand charts, highs and lows and everything.
When you know how to do that.
Yeah, sure. So I try to teach you exactly how to do the trade. So there's 2 updates a day. I'm sure you've noticed that. The first update is going to be about 10 minutes, and I'm going to walk you through how to place the trade. Now, it shouldn't take you more than 2 minutes. And by design, the reason we only trade a single security is to make this easy to follow and fast. Okay. Now the SPY gives you 504 stocks with a single security. So that's a beautiful, beautiful equity to own for the long term, whether you're doing covered calls or not. Now, am I going to be teaching you, like how to do all kinds of crazy stuff? No, I'm going to teach you what you need to know.
So then how I know why to buy, let's say, why to buy here or there? I mean, so you will be telling when to buy.
Yeah, so my job is to sell the trade alerts. So I have a bunch of people coming in to our program. Okay, we don't have this 10-year track record, but we've managed to get people with $500,000, $1 million and more. We have a huge group of people who trust us with their entire nest egg or a huge portfolio. So my job is to not only sell each trade alert to new people coming in, but to make you understand why we're doing it. So you'll see every trade alert is really, that's all you need. That single video will teach you everything you need to know about every trade. And so, yeah, we've been able to do that by consistently generating tiny profits and protecting everyone's capital. We have a very fast growing group here who love it. You're not going to get rich, but you're going to have a lot of protection and slowly grow your account.
So it will not be explained why we buy on, because it's first day for me. I just have kind of confused.
Yeah, I explain exactly why we do the setup. So there's 2 updates. The first update's 10 minutes. It's in the morning. It includes how to do the trade and why. The second update is daily. It's right after the market closes. I'm going to review all our portfolios, and I'm going to tell you why we're doing what we're doing and what's going on around the world to basically cause you to need extra protection. My main job, I can show you how to copy Wall Street and steal money out of the option market. That's easy. My main job is to try to predict earthquakes before they happen so we can have extra protection when it does happen. Right now, I'm predicting an earthquake is coming up because I think the US will raise tariffs on China. And I think it's going to happen maybe right after the 4th of July. So if I'm wrong, we'll continue to pull money out of Wall Street, no problem. But if I'm right, we have this extra protection during this little window where I think there's probably some bad news that will be released. So that's really the extra value that I do provide, is trying to predict earthquakes in the market before they happen. And so you'll see all the content that I'm reading all day, from Bloomberg to Seeking Alpha to Zero Hedge to CNBC, you name it. We're consuming this content, pulling out the highlights. That's what's in the evening video. So you can see exactly what I'm looking at, and I summarize it for you, because otherwise it would take you 8 hours a day just to be close to the amount of content we're consuming to try to have a good idea of what could go wrong.
Yeah. Jason's going to be working for you 18 hours a day, 6 days a week, monitoring the markets and financial media.
And at the end of the day, it doesn't mean you're going to have a lot of changes in what you do. It's just tiny tweaks that can make a big difference. This first week, we've been buying put options. And that's because there's a very easy to predict risk right ahead. Now, if that risk doesn't play out, I'll be shocked, but we won't lose any money. We'll make our normal boring return. If we do get a shock, we'll make a little extra. Instead of making 1% a month, we might make 2 or 3. Someone says, why not the QQQ? Yeah, QQQ is great. So if you do notice, I have a growth section. Give me a 30% crash in equities, and I will rotate you into the QQQ. But you give me a stock market at all-time highs or 2% under, I'm trading the SPY. SPY trades options 3 times a week, and it's about 4 times more liquid than the QQ. So you give me a market that's overvalued, I'm going to trade the SPY defensively. You give me a stock market that's crashed 30%, you bet your bridges, we'll go right to the QQQ.
Yep. And 3 times the option premium is definitely something we prefer.
Yeah, so 3 paydays on the SPY. QQQ only has 1 option a week. There's no other stock or ETF that has 3 option expirations a week. It's crazy. A lot of people don't even know that about the SPY. And they're advanced options traders.
Let me ask the crowd, did anyone actually know that there's 3 expirations on the SPY in a week?
Yes, I did. I trade it all the time.
Nice.
Nice. So that's great to hear.
1 out of 20.
All right, guys, last chance for a question. Don't forget, we do this weekly. You can attend it for an unlimited amount of times. And now, once your free trial does expire, you're just going to get the evening update. You're not going to get the live trades. So you'll continue to get great content as long as you don't hit the unsubscribe button. A lot of people sit here and watch us for 3 to 6 months and then decide, all right, usually they wait till they had a big loss and then they're like, all right, let's give this a shot. So hopefully you guys can jump the gun, start following it, even if you're just paper trading, see it works, and we'd love to get you full time with us here. All right, guys, I'm going to go ahead and close this out, and we'll try to get you a copy of it if it did record, and it looks like it did. So we will have a recording we can share with you, and I'll try to get that out either this afternoon or tomorrow. And you'll automatically be registered for next week's webinar. Just remember, if you do upgrade from the free trial to the paid, you'll get a few things. 1, you'll be on the customer only webinar. So you can actually talk to people who've been following the program. Yesterday was a great webinar. Everybody was happy making money. And that's right after a big crash in May. So if you lost money in May, you might be wondering what's going to happen in the next crash. Are you going to make money or are you going to lose? Second thing we're going to do is give you a 30-day free trial to the Diamond and the Whale. You can see our trades Monday through Friday. All right, thank you, everyone, and looking forward to getting an evening update out to you in just about an hour.